Okay, the first out of chapter 3, problem number 28 on page 140. And on this one, Patrick Corporation acquired 100% of O'Brien's company's outstanding common stock for $550,000 in cash. They reported net assets with a carrying value of $350,000, and there are three that were undervalued. Trademarks with a fair value of 160 and a book value of 60. Customer relations that were unbooked, unrecorded, but had a fair value of 75. And then equipment had a fair value of 312, but the book value was 342. So it's asking us to and this was on at the end of the first year. They give us financial statements, which is what is presented here. Okay, so the first thing we need to do is calculate goodwill, and let me see if I can get a. So we paid $550. This so that we can read the numbers. Okay, so we paid $550. Book value was $350. That's an excess of 200. Then we had trademarks. Make this a little bigger so you can see it. Trademarks with a fair value of 160 and a book value of 60. Relate customers. Was 75,000, and equipment had a fair value of 312, where a book value of 342. Okay, so if we take the excess and we subtract the sum of the three identified assets, we get we added that right there. Let's subtract that. We get 55,000 for goodwill. All right. Okay. So having done that, just like last week, the first thing we want to do is remove the stockholders' equity on the subsidiaries' books. So 100,000 and 392. And the offset of that goes to the investment in O'Brien, which is 492. All right, so that is stockholders' equity. Oh, hold on. Wrong one. It's stockholders' equity at the beginning of the year. 250. And that is 350,000. Okay, so that's the S entry. The A entry is increasing the trademark by 100,000. Increasing the customer relations by 75,000, and reducing by crediting the equipment by the 30,000. So that is that plus that minus that. All right, so that's the 145. Oh, I'm sorry. And goodwill. The goodwill, which we calculated over here at 55,000. Okay. So that's the S and the A, and that's the same because it's the end of the first year of operation. So that's the same as what we had in Chapter 2. The D entry is dividends. So we had dividends paid of 222. I'm sorry, dividends declared of 80,000. And D of 80,000. And that's because under the equity method of accounting for investments, you reduce the investment account by dividends as they're declared, and you increase the investment account by income, your pro rata share, and we own 100% of O'Brien Company. So that gives us the I entry, which is income. And we recorded 210,000. And that is here, 210,000. And that brings the investment account to 0. Now the last thing is that the customer relations are assumed to have a 5-year remaining life, and the equipment is assumed to have a 10-year remaining life. So that's a net of $12,000. So the E entry is depreciation expense is going to be decreased by the 3,000. And amortization expense is going to be increased by 15,000. And the offset will be the trademark will get the credit for the amortization, and depreciation, the equipment accumulated depreciation will get the offset for the depreciation. Oh, I'm sorry, not trademarks. It's the customer relations. Gets the E entry. All right, and everything is correct. Okay, next up we're going to do problem number 30, which begins on page 141 and continues on to page 142. And in this one, Giant acquired all of small company's stock on January 1, 2014 in exchange for cash of $770,000. On that day, they reported common stock of 170, retained earnings of 400. At the acquisition date, 90,000 of the fair value price was attributed to undervalued land, while 50,000 was assigned to undervalued equipment having a 10-year remaining life, and 60,000 of the excess was viewed as goodwill. So we don't have to compute anything. It tells us that we have 90,000 in land, which has an unlimited life, 50,000 in equipment with a 10-year life, so excess amortization of 5,000 per year, and the remaining 60,000 is goodwill, which also has an indefinite life. So the total is $5,000, and that makes up the excess of the purchase price, which was $770,000 minus $570,000 that was paid. That was the equity in small at the acquisition date. All right. So it's now 2018. On that date, Small owes Giant $10,000. They declared and paid a dividend. And so what we need to do is do the SADI entries, and I will walk you through all of that. All right, so let's go down here. All right, so the S entry is beginning retained earnings and the common stock. So beginning retained earnings was 620. Common stock was 170. And the offset is the credit to investment in small. And that's going to be equal to the sum of the two. Alright, so 790 is our S entry. The A entry is the land, which was 90,000. The equipment was originally 50,000. So at the date of the acquisition, we had undervalued equipment of 50,000, but we've been depreciating that. So we acquired it at the beginning of 2014, so we operated it 2014, 15, 16, and 17 thus far. All right, so that was amortization of 5,000 times 4. And we're going to reduce the A entry by that amount each year until the equipment goes to zero, when it gets fully depreciated. So the A entry at the end of the 5th year of operations, it's 30,000 left. And then we had the 60,000 in goodwill. And the offset to that is the investment in small. And that's going to be this plus this plus this. So 180. The D entry is dividends declared of 110. And the investment in small gets debited for that. The I entry is 135. And you'll see when we enter in the credit portion of the I entry, right now our balance in investment is 135, and that goes to 0. And that leaves us the E entry of $5,000, which is offset with the equipment at net. And the last thing that we need to adjust is small owed giant, $10,000. So that is a P entry, and we need to reduce current assets because it's currently sitting in accounts receivable here with Giant. So we need to remove that because that's an intercompany. It's overstating current receivables and current liabilities. And 10,000. And that is that. So everything is correct, and that is the right answer. The investment is 0, the balance sheet balances, and all is right with the world.